Welcome back to Trading Hour. Markets holding up some small gains. Sensex up about 42 points. Nifty only about 11. But we have Jyotivardhan Jaipuria from Valentis Advisors joining us now, to discuss more on market fundamentals and his top sectoral picks. Jyotivardhan, thanks very much for being here. You've previously said, of course, that this FPI selling pressure we've been seeing will perhaps see some corrections as earnings improve. Given the current situation where the rupee weakness is concerned, the sustained FII selling we've been seeing, and now the more recent trigger that the markets will have, which is the expected Fed rate cut, what to your mind will drive a meaningful reversal of these FII flows from here?
Yeah, so there are three reasons. So one is if we see performance. India's been down 22% versus the MSCI emerging market this year. And that's India's worst performance since, the market was opened up for FPIs. Second is if we see where they are positioned today, the FPIs are underweight by around 2.5% on India. And this is the highest underweight they've ever been since, they started investing into India. And third is, when you look at valuation from their point of view, valuations have become a bit more reasonable because a year ago, India was trading at a P which was 100% premium to what the MSCI was trading at. Though India's valuations have not changed because all the other markets in emerging markets have gone up. Now India trades at like a 55% premium. And this is again in line with long-term averages. So if you think about it, there's extreme bearishness. The market has done badly already and valuations have become more reasonable. So as we get, let's say, if Fed keeps cutting rates, emerging markets will see more flows and that will help India. Second is if we get earnings recovering, that will start helping, on the margin flows coming to India. And third is could be the trade deal. If we get a trade deal coming, then that again could be positive for FPI flows.
But if you could point out for us, what are the specific pockets of value you're finding right now with, some visible shoots of growth?
One would be the banking space. So banking, as we see, what happened was, there was an impression banking, which happened largely because of interest rate cuts. And it's a very standard cycle, right? Once the interest rate gets cut, then, your loan rates get cut immediately, whereas deposit takes some time to reprice. So we are probably close to a bottom on the NIM pressure. And going forward next year, you'll see NIMs expanding. So first half, the bank's earnings grew, like they were slightly negative. Next year, we think bank earnings will go at 12 to 15%. So that's clearly one area where growth will come back and where valuations are not very expensive. Like if you look at valuations today versus, let's say, a 10-year average, banks are trading below the 10-year average in terms of valuation. So that's one space we are looking at, which is attractive. The other space which we are looking at, which we're not buying immediately, is the cement space. So cement we are not buying now because, this quarter is not going to be good. Monsoons have got prolonged. But, as we enter next year, it's an industry which has consolidated a lot in the last 18 months. Demand is fairly strong and, capacity increases are starting to slow down. So we think pricing power will come back to the cement industry next year. You'll see good growth coming over there and stocks have been fairly stable. They've actually underperformed the market. So that would be the other sector which looks interesting to us.
All right, you like banks and cement. Just a final question, Jyoti, before we let you go. The broader markets have seen a big amount of pain. A lot of individual stocks are down 40, 50, some even 70% from their highs. Are there any attractive opportunities there from the ones which have seen a big damage? Any particular names that stand out for you?
So, where we have been looking at is some of the names which are geared to the US market. And, assuming that if the tariff remains at 50%, which it is today, earnings will bounce back for many of those companies next year and valuations have become attractive. So in particular for us, there are a couple of chemical companies which are starting to look attractive there because share prices have come down quite a bit. Earnings near term have got hit. You do analysis assuming no change in tariffs and, you probably make some money. If tariffs reverse back and that 50 becomes, let's say, even 25, then you can see a big upside coming over there. So we are looking at some of those pockets there.
Could you give us a sense on some of those names without getting into specific ones? Say, give us a basket of 4 or 5 names which have exposure to the US. So the street gets it.
Yeah, if we take any of the chemical names, like, it's very easy to just do percentage of sales to the US and you probably will, get where some of these names. So, you can just choose after that and pick whatever you like over there.
Okay, take that point. We'll do that exercise. Thank you so much for joining in and giving us your views. Take a short break, come back. In fact, we'll speak about, the ones that benefit from the US itself, the shrimps. We'll have a discussion on that. And obviously, we'll talk about the markets as well. Stay with us.
"26 years of